zero-sum gain proposition is very interesting. It comes out of a paper he wrote that appeared in the Financial Analyst Journal in 1991. And the argument is basically that, that because everybody must hold the market, if you go active, you'll pay fees, and some people will win, some people will lose, but overall, everything will add up to the market return, less the fees, and therefore, if you go active, you're going to do, on average, people will do worse than the market return. Now, he's a Nobel Prize winner. You've got to take some notice of what he says. It's very seductive logic, and it's been very influential. But there's another Nobel Prize winner there, had a paper along with called Joseph Stiglitz, who had a paper with Sandy Grossman back in 1980 in the American Economic Review. And it had a different perspective of this issue. And it said that basically should be an equilibrium out there where those who spend money on research will incur greater costs but get greater returns. And those who don't spend money on research, that is, they go into passive investments, they get lower returns, but they pay lower costs. And both groups should actually get approximately the same return, at least on average. Of course, around the average, there can be variations. Now, the evidence actually lines up a lot better with Grossman and Stiglitz than it does with Sharpe, particularly Jonathan Burke from Stanford and Jules van Binsbergen from Wharton did some papers on this initially, and other people have been looking at it through this lens and saying, is there gross alpha there? And usually there is. But is the net alpha around zero? And it usually is. So that sort of looks like that equilibrium whereby, we have some growth alpha, but on average and in equilibrium, it's eaten up by fees, and active management actually works. But it's but you probably don't want to, the average, on average, it doesn't hurt you, it doesn't help. But if you can pick good managers, if you can find a skilled manager before everybody else realizes, you can actually do quite well out of it. Another point about Sharpe's zero-sum gain is that it has some very strong assumptions in it, and it doesn't actually consider market dynamics. And when you sort of open up the assumptions and look more deeper, there's actually some wiggle room in there for active management, even if it held sort of on average over time. So firstly, there's no pure market universe. So it imagines that everybody is holding this one market universe and they're all competing in that. That's not the way that investors operate. They operate in different spheres. Secondly, index funds need to trade. It's not right that the index is just static. It is maybe in one particular period, but over time it changes. Stocks come in, stocks go out. So there can be quite a bit of trading in index funds. And when they trade, they have to trade with somebody else, which will be active managers. And that can create some wiggle room for active managers. The third thing to note about it is that Sharpe doesn't rule out active managers winning at the expense of others. And so this is where relative skill comes into play. And this is where the Grossman and Stiglitz equilibrium could come into play. And finally, I think this is the most important point about Sharpe's zero-sum gain, is that it operates in return space only, and gross returns, that is the return that the market delivers. But what people also worry about when they're investing are things like risk, tax, and so on. So you could actually see one group of investors, underperforming the market in gross terms, but if they're getting a tax benefit, they could actually be outperforming the market because they're actually managing to their tax situation. Most of that research, and indeed the conclusions, is usually active management doesn't outperform. It doesn't add value for investors. But you have to be a little bit careful with that evidence and interpreting it. In particular, most of it comes from US equity mutual funds. And that raises a couple of points. Firstly, they're talking about after fee performance, and a lot of the research takes off the rack rate fees. So in the main database that's used, that's about 1.3%. So hidden underneath that sort of net negative return on average is actually some positive alpha there. It's just eaten up by fees in the data. But that also raises the point that if you're paying a lower fee than the rack rate, the balance might be tipped. And I'm specifically talking about here is if you're in the wholesale or institutional markets versus paying the full retail rack rate. And that can actually change the equation quite a bit. The other point to note is that research is largely in US equity mutual funds. And US markets are probably the most institutionalized and competitive markets in the world. And there's a bit of evidence that when you look beyond the US that and into other non-equity markets, that there is alpha there, that active management does work. I'm going to refer back to some work I did when I was at Russell Investments with a person called Don Ezra, who's a bit of an industry legend and was the head of consulting at Russell Investments back when I was there many years ago, and we were dealing with this issue of active versus passive, and we tried to put up a way of looking at the issue to say how would you choose if you go active rather than invest in a cap weighted index. And we think there were 5 preconditions that you would actually contemplate active management. The first is in markets where you can't actually buy an index. Now, that's most of alternatives. So when you look at alternatives or private markets, you have to be active. So there's a role for active management there. The second condition was where the index is at odds with the objectives you want to achieve. That is, you don't want to hold the index, you want to achieve something else because it fits your objectives. The third one is the index itself is inefficient. It's not the best way to hold the market. There's a bit of an argument around this, around whether you're better off with an equally weighted portfolio. There's also fundamental indexing released, which was put out by research affiliates, makes the argument that the cap weighting is inefficient because it contains the most overvalued stocks, and you're better off using some other weighting mechanism, which they do, and that will outperform in the long run. The fourth reason you'd be active is because the environment actually favors active managers. There's a couple of reasons why that could be the case. Firstly, active management tends to cycle. Active managers do well in some market environments and not so well in others. For instance, they do well when there's high volatility in the market, cross-sectional volatilities, when there's lots of variation going between various stocks. So that might be a reason. Another is that you could be investing in a market which isn't very competitive, and there's inefficient pricing. So I think that's what's happening in some of the markets outside the US. Down here in Australia, for instance, active management has done well over the long run. A third reason is that the market could be populated by a group of patsies that you can exploit, the active managers could exploit. They could be governments, for instance, or they could be rabid private investors that trade too much and just create opportunities for active managers. So I think there's some of the markets overseas are like that. So that would be the fourth reason. The fifth reason is you have some skill, and that skill could be either you yourself can identify good investments, and you can beat the market. And the other reason is you could actually be able to identify good active managers, and you could pick them. And so if you have that skill, you could justify going active regardless of what's happening to the average. So if I could bring that all together, where I sort of land on this is whether you should be active or passive depends on your situation and what type of investor you are and what you're looking for. For some people, active will be right. For some people, passive will be right. Institutions probably have a better shot at it because they pay lower fees. They probably have more capability or access to capability to select good managers. For private investors, it becomes a bit tougher if you're paying a higher fee and you don't have the ability, as much of ability to pick active managers. But because of all those reasons, there's many reasons why you would choose active over passive, and I don't think there should be a blanket rule. So I just probably finish off here and saying the active to passive debate has been looked as two warring tribes. You're either active or you're passive. I think that's entirely the wrong way to look at it. The way you should look at it is active or passive. Which one is right for me?